Hello everyone, welcome to the market opening bell on Monday, July 7th, your 10-minute guide to the stock market. Last week, Hong Kong stocks weakened with the Hang Seng Index hitting a low of 23,691 on Friday, down 379 points at its worst, closing at 23,916, down 154 points or 0.6%. The Hang Seng China Enterprises Index fell 39 points or 0.5% to 8,609, while the Hang Seng Tech Index dropped 18 points or 0.3% to 5,216. Total market turnover was 267.8 billion Hong Kong dollars. For the week, Hang Seng fell 1.5%. Hang Seng China Enterprise Index fell 1.7% and Tech Index 2.3%. Southbound funds net bought 6.683 billion Hong Kong dollars of Hong Kong stocks on Friday, including net buys Xpeng totaling 872 million Hong Kong dollars, SMIC 768 million, China Construction Bank 167 million, Guotai Junan International 142 million. Net sales Alibaba 1.487 billion Hong Kong dollars, Xiaomi 813 million, Tencent 174 million, Meituan 173 million. Data shows Southbound funds net sold Tencent for 25 consecutive days, totaling 23.583 billion Hong Kong dollars. Alibaba for 5 days, totaling 6.308 billion, and net bought SMIC for 11 days, totaling 8.563 billion. Technically, the Hang Seng Index Friday low of 23,691 nearly filled the upward gap from June 24th between 23,689 and 23,833, closing at 23,916. It's close to 24,000. Breaking above 24,000 and reclaiming the 10-day and 20-day moving averages would signal the end of the short-term correction. Otherwise, a further decline could test the 50-day moving average, now near 23,500. Shanghai and Shenzhen markets diverged on Friday. The Shanghai Composite Index hit 3,497, nearing 3,500, an 8-month high, closing at 3,472, up 11 points or 0.3%. The Shenzhen Component Index peaked at 10,610, closing at 10,508, down 26 points or 0.25%. Combined turnover was 1.4285 trillion yuan, up 118.8 billion yuan from the previous day. For the week, both indexes rose over 1%. Reports indicate the CSRC recently held a meeting to optimize equity and bond financing, mergers and acquisitions, and advance capital market reforms, particularly for the Chinex and Starboards. The renminbi US dollar central parity rate was 7.1535 on Friday, down 12 pips. In the first half of 2025, Southbound funds net bought 731.187 billion Hong Kong dollars in Hong Kong stocks, nearing the 2024 full year total of 807.866 billion Hong Kong dollars, and over doubled 2023's $318.841 billion. Southbound holdings increased across all sectors, reflecting mainland investors' strategic allocation to Hong Kong stocks. Sector rotation was evident. Q1 focused on IT, early Q2 on new consumption, and the past months on biotech and financials, aligning with market preference for high growth and high dividend defensive stocks, balancing growth and high dividends. Taobao flash sale announced a 50 billion yuan subsidy program. Since its launch, chain restaurants and small merchants saw monthly business growth of 1.7 times and 1.4 times respectively. Orders for coffee, drinks, desserts, snacks, and Western fast food grew over 1.5 times monthly, with afternoon tea and late night orders up over 1.7 times. Over 40 cities hit record high orders, with new first-tier cities like Hangzhou, Wuhan, Changsha, and Chengdu doubling, and cities like Guangzhou, Guiyang, Taiyuan, Nanning, Hohhot, and Foshan seeing three times growth. This may erode Meituan's food delivery market share. Meanwhile, Meituan plans to open two Happy Monkey supermarkets in Beijing and Hangzhou by late July. Staffed by its 11 supermarket team, the model targets Alibaba's Hema neighborhood stores, focusing on extreme value to attract customers. FWD Group stock code 1828, which will be listed today, closed at 36.75 Hong Kong dollars in Phillip Mart's grey market on Friday, down 3.3% or 1.25 Hong Kong dollars from its IPO price. Excluding fees, a 100 share lot lost $125 on paper. US stocks rose last week. Congress passed the Big and Beautiful Act before July 4th, potentially straining fiscal budgets but boosting growth. Strong jobs data pushed the S&P 500 and Nasdaq to record highs on Thursday's half-day session. For the week, the Dow, S&P 500, and Nasdaq rose 0.7%, 0.8%, and 1% respectively. Market focus this week will include first, July 9th deadline for reciprocal tariff suspensions. Watch Trump's policy moves and tariff talks. Second, US-China TikTok sale negotiations, with Trump indicating a deal is near. Third, geopolitical developments in Russia, Ukraine, and Gaza ceasefire talks. Our stock pick today is LK Technology, stock code 558. LK Technology primarily focuses on the design, manufacture, and sale of die casting machines, plastic injection molding machines, and computerized numerical controlled CNC machining centers. In the development of new energy vehicles, lightweighting has become a core requirement. Integrated die casting technology, with its advantages of reducing component counts, lowering vehicle weight, and improving production efficiency, has been widely adopted in new energy vehicles manufacturing. Plastic injection molding technology is also extensively used in automotive interiors and electronic components, with increasing demands for precision, quality, and aesthetics as vehicles become smarter and more comfort-oriented. OK Technology's die casting machine business is pursuing a dual-pronged strategy. On one hand, ultra-large die casting machines benefit from downstream customers' deepening commitment to integrated die casting. On the other, small and medium-sized die casting machines continue to generate revenue by catering to diverse applications such as 3C and home appliance components, ensuring the stability of the business foundation. In the injection molding machine segment, sales of all-electric injection molding machines tailored for high-precision sectors like medical and optical applications have surged significantly, emerging as a new engine for profit growth. Leveraging advanced servo drive systems and precision mechanical structures, the group achieves industry-leading performance in critical parameters such as pressure control and positional accuracy. The rising sales proportion of high-end models has driven deep optimization of the injection molding machine product structure, laying a solid foundation for sustained profitability growth. In the CNC machining center business, the group has enhanced decision-making efficiency through management team restructuring and expanded market reach by broadening domestic and international sales channels. A significant breakthrough is the strategic partnership with Oryx, a globally renowned financing and leasing institution. Through an innovative model integrating financial tools with manufacturing, the two parties are accelerating penetration into low-tier markets via financing and leasing, boosting both market penetration and brand influence for CNC machining centers. Looking ahead, the group has taken a lead in developing TPI semi-solid magnesium alloy forming technology, enabling customers to enter the magnesium alloy product market. To further translate forward-looking technological research into stronger market competitiveness, the group will deepen its innovation ecosystems, on one hand focusing on new materials such as magnesium alloys, composites, and high-temperature alloys for lightweight and high-performance applications. On the other, closely collaborating with enterprises in cutting-edge fields like artificial intelligence and the low-altitude economy. By proactively exploring potential market demands, the group aims to advance the research and development of next-generation intelligent equipment technologies. Recommendation: buy at 3.2 Hong Kong dollars, target price $3.6, stop loss at $3.05. I do not hold the above stock.